Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry weekly prep webinar. It is currently roughly 8 p.m. Eastern, Sunday, June 16th. We're going to be running through a quick recap of the key events from last week and price moves, looking at our fresh week scope of events, some sentiment analysis, and then some technical and fundamental intraday analysis and trade ideas across main pairs and asset classes that we look at week in and week out. So let's jump right into it, and let's start out here with our weekly recap. Overall, last week had some key events in focus, from our US CPI release, FOMC rate decision, Bank of Japan rate decision, and some minor data reports in the mix as well. Overall, we did notice that CPI was still declining, but it wasn't really fueling rate cut bets any further. On gold, we ended up remaining in this corrective structure, very similar to the sequence of events to the left. To the left here, you can see from these all-time highs, we had a pretty aggressive bearish impulsive leg that printed a new intraday lower low. But what followed after that for a good week here was a secondary phase of market structure and a larger pullback phase. Then you can see we had this larger bearish move down again, an impulsive phase printing new lower lows. This was from, of course, a reactive headline 2 weeks ago at the end of that week, where we had China confirm that they will not be increasing gold purchases anymore. And that following New York session, we had surprisingly optimistic non-farm payroll data. Again, similar to the sequence of events to the left, it was a large impulsive bearish move that printed a new lower low, and we're starting to see stronger bearish market structure forming on the higher time frame. Last week, unfortunately, after this bearish impulsive move, we are entering again another corrective phase in the market here. Even with the CPI data, even with FOMC, even with some of the normal price action moves, we did not break key lows or key highs. It was very repetitive to this large post-bearish impulsive move here, where we were just moving in this wave formation before seeing a deeper pullback phase leading to the bearish leg down. Now, what I am looking at here is that none of the bullish moves in the corrective phase ever fully equalized the bearish move to the left here. Very similar to here. Even though we had some pretty aggressive bounces through CPI, or even this bounce at the end of the week, which was against my analysis and completely went against what I was expecting, it still did not fade out the bearish impulsive move. In my opinion, we may see a similar sequence of events of remaining in this corrective structure before we retest key supply zones and still see bears in control here, printing these lower lows. In my opinion and through my experience, it does look like gold buyers are starting to show more signs of exhaustion from these all-time high prices. We are starting to see stronger bearish market structure forming here. And on top of that, we're having fundamental catalysts supporting some bears rather than bulls. It does look like rate cut premiums have been priced in. It does look like we're not seeing any new fear, uncertainty, or doubt in regards to reactive events, as we have not had any new geopolitical tension escalations or any other reactive events such as banking sector failures or compounding recessionary scare data to lead into more gold demand here. It does look like, in my opinion, that gold is just in that secondary phase of market structure highlighted in the previous event here in blue after having such a large bearish impulsive move. So the main thing to recap from last week on gold was that CPI data and FOMC did not really lead to any change in structure. Gold was still in this secondary consolidation phase. And even if gold wants to see some short-term upside into the 2360s here and retest of structure and key supply zone, it does look like we could see another bearish impulsive leg being created to print another lower low. And that might be the drive down where we finally start to break below that 2280s demand zone and get some deeper, higher time frame pullbacks, which we're going to be talking about in our macro outlook webinar too. The same time that gold is starting to create this higher time frame bearish structure, conveniently, we had, of course, China announce a slowdown of gold purchases. And in terms of intermarket correlations, we are noticing dollar starting to pick up some more strength, which we're going to talk about individually there. Now, obviously, these corrective phases of market structure can be quite difficult to play and also difficult to time. For example, here, after we had major profit taking by buyers here and short sellers in control, as we did not have enough buy side liquidity or fundamental reasons to see more buy orders pool into the market from these record breaking all time high prices, you can see this corrective phase held weight for an extended period of time. We even saw a deeper squeeze to the upside before completely fading it out. That's exactly what it looks like is currently taking place from the rough 2300 lows to the rough 2340s, where we could even see another squeeze into the 2360s and still seeing some bearish impulsive legs to the downside. What does this mean? Well, it means until we have any key fundamental events to lead to more outflow on gold, until we have more economic data unfold from the US to potentially see more inflow in dollar and outflow on gold, we have to be very adaptive to this secondary phase of market structure where you can have these very aggressive intraday price waves before seeing the next main market move take place. Right now, even with the CPI data last week in FOMC, we're still not really breaking these key highs or lows and could still see some general movement like this before seeing another bearish impulsive leg to the downside if the US data is still remaining optimistic or rate cut premiums are priced in, or we get more reactive events of other central banks slowing down their gold purchases as well. This is what we need to be adaptive to. So that was the main recap on gold, is that we're in a secondary phase of market structure, primarily consolidating there. And that is still the part of market structure that we're going to be playing into this week and need to be very adaptive to. The next main key recap from last week was dollar inflows. Even though we had declining CPI still feeding into rate cut bets short term, which was this downside move here, it was still not enough for dollar to break that 104 to 104.2 demand zone. What that tells me is the inflation data was not optimistic enough to bring any new liquidity and flows into the rate cut bets narrative. It shows me that the overall dollar inflows are still holding more strength, especially when you're looking at the Federal Reserve positioning compared to some of the other central banks, such as ECB, Bank of England, Bank of Canada, where a couple of them have already done rate cuts, and the other central banks are still expected to do rate cuts before the Fed, keeping that global international macro rate differential active and still leading to the world reserve currency dollar seeing more inflows. With dollar seeing more inflows and still respecting the bullish structure here, where we're not breaking below the 104s just yet, it still looks like with dollar holding above 105 or trading above 105.6, that we could be digging up to the 106.5s and 107 key level before assessing bearish price reactions accordingly. Dollar seeing more inflows and having that macro rate differential active of other major central banks expected to cut rates before the Fed, or some of them have already done rate cuts before the Fed, such as the Bank of Canada and ECB, which both performed their first 25 basis point rate cut. This is still leading to more of a bearish bias on Euro USD, and bearish bias on GU. We adapted to the bears very well as we started to notice CPI was not enough to fuel more rate cut bets into the US dollar for some bears there. The macro rate differential holding weight, snapping back below these previous highs, and we adapted to the bears on GU from 1.27 down and below the key level 275, with the adaptation points on Euro USD being back below key level 1.079 and below 1.073 here. So the main fundamental factors leading to Euro USD being more bearish and GBP USD being more bearish is having more demand in your world reserve currency dollar due to the macro rate differential holding more weight and less demand in your basket of risk currencies, such as the Canadian dollar, Euro, NZD, AUD, GBP, and so forth. This is obviously the opposite impact on USD CAD, where USD CAD is starting to show us potential more bullish structure forming on the intraday timeframes here, and that we could still be retesting into that key last high point into the 1.382 price handle. Now, UCAD has been consolidating quite aggressively because dollar was consolidating. We just finally started to get that dollar breakout towards the end of last week. But hopefully now, with the macro rate differentials holding more weight, still having more demand for your world reserve currency due to rate cut bets premiums for the Feds being priced in, and no new events bringing any new liquidity into that narrative, it does look like if dollar's holding above 105 and breaking above this gray zone, we can be seeing dollar digging into these prices to the left here, at least retesting into the 106.5s and going into the 107s while still respecting this bullish structure formation. And then this will be the next key area where we may see an aggressive bearish pullback phase, digging into these 107 prices and then potentially seeing a corrective wave. For the time being, we're still seeing dollar inflows are active, which we adapted to very well at the second half of last week, and is still what I'm looking to play going into this week. I do still want to continue this Euro USD bearish structure forming, potential pullback sells, GBP USD bears coming in, and potential pullback sells, as well as UCAD buys after a pullback and continuation to at least be retesting into this gray zone and price sensitivity area at 1.382s. So we are starting to see a few things. Rate cut bets premiums being priced in, other central banks doing rate cuts before the Fed or still expected to do rate cuts before the Fed, the Feds themselves still taking a slow and steady approach and not rushing rate cuts at all. So no new events to feed into that greed stock market narrative. And the last event from last week was impacting the Japanese yen. This was, of course, your Bank of Japan rate decision. What we were anticipating in the clues we got a day earlier from the Bank of Japan rate decision was that we could see them confirming slowing down, aka tapering their bond buying program. We understand that the Japanese yen has been extremely bearish as the Bank of Japan has kept interest rates so low, but not just that. One of the main reasons the Japanese yen has remained so bearish is the Bank of Japan continuing this absurd unlimited bond buying program, which is heavy stimulus, still leads to more demand in bulls in the Japanese stock market, but leads to aggressive bears in the Japanese yen. At the actual rate decision, first, they didn't bring anything new to the table. It led to yen still being weak, spiking down to these historical higher time frame lows, and just some price whipsaw moves. What was very important was Bank of Japan Ueda's speech that was during the pre-London hours, a few hours after the rate release. This is when our main analysis on GJ kicked into high gear. What we were expecting on GJ is that if we snapped back below these previous highs and Bank of Japan Ueda through his speech confirmed that they're going to be tapering off the bond buying program, slowing down those bond purchases, starting to unwind that ultra loose policy, that this was a very clear hawkish signal and we can see some Japanese yen strength. The strength wasn't anything absurd, but it did lead to us snapping back below those previous highs, having this very aggressive bearish downside move, which a lot of people got to take advantage of in the Capital Hungry service and chat here. Now, overall, we're not seeing a clean path to downside just yet. We could still be retesting into these highs, partially correcting some of this downside move, confirming we don't print any new highs and more buyers exhaustion before starting to position ourselves in those higher time frame sells on yen pairs. Not just GJ, but also EJ, CAD JPY, AUD JPY, and so forth. Because if the Bank of Japan is going to start to stack on more signals, slow and steady, of tapering off their bond buying and doing more rate hikes, we will see market participants pooling in a lot more buy side liquidity on the Japanese yen from these lows and starting to see against this overall bearish trend, yen having some more aggressive bullish plays if we can't trade below this demand zone, potentially on the minimum going up to this last point of interest, and even seeing a bullish rally over the next weeks and months going into this price point up here. That is something I want to look at. After some pullbacks, I do want to continue some of that Japanese yen strength on GJ, which is what we primarily look at. But even for the other members in Capital Hungry who trade AUD JPY or CAD JPY or Euro JPY, I do want to start to position myself in some higher time frame GJ sells. If we're not going to be breaking back above these last higher time frame high positions, starting to shift out of structure here, and potentially, of course, trading below the 199s as that key make or break area. Okay. But in terms of the recap of key events of last week and price moves, that's pretty much it. Quick little summary. Rate cut bets premiums being priced in on the dollar, failing to break the 104 demand zone, still having the macro rate differentials active of other central banks already performing rate cuts before the Fed, and the ones that are left over expected to still do rate cuts before the Fed. ECB and Bank of Canada already did their first rate cut. Bank of England still expected to do their rate cut before the Fed here as well. FOMC also confirmed they're going to be taking a continued slow and steady, data-dependent, sit-and-wait approach and are not in any rush with their rate cut cycle. This led to dollar bulls. We adapted very well to Euro USD sells, GBP USD sells, UCAD bulls, and it's what I want to continue this week. Recap of Japanese yen is that Bank of Japan Ueda through his speech did confirm our prediction coming true, which is them tapering off their unlimited bond buying program, starting to decrease their bond holdings, and that is a very clear hawkish signal, which gave us this bounce on the yen. I do want to see if yen doesn't fade out this upside move, still holds this demand zone, starting to see a rally on the yen and potential higher time frame short positioning on Japanese yen pairs. Lastly was gold, which is still in this corrective structure, very similar to the sequence of events to the left, and it's still something we have to deal with this week, unfortunately. Dollar pairs are starting to show us cleaner structure. GJ is potentially starting to show us a shift in structure and sellers coming into control. Gold here is still in this secondary phase, very similar to the sequence of events to the left after a large bearish impulsive leg, where we could still be consolidating, even coming to retest into the deeper 2350s and 2360s before really starting to look for higher time frame bearish positioning. But I am starting to see the bearish catalyst on gold starting to stack up. Buyers profit taking from these all-time highs, not just here, but really failing to trade above these highs to the left here. Starting to get stronger, larger, bearish, impulsive moves and short-term corrective bullish moves. China reactive headline of them decreasing their gold purchases moving forward. Bearish technical structure starting to form here. Rate cut bets premium starting to be priced in. If we fail to break above the 2360s and of course break below the 2280s, I'm not expecting gold to melt down to 1500s for no reason. I'm not expecting gold to be bearish long term for the next year, but seeing a higher time frame correction into this last accumulation area here and correcting this upside move to the left by breaking that support level would not be out of the ordinary at all. It is something we need to prepare for, especially if we don't have anything new and advantageous feeding into rate cut bets, and especially from a reactive standpoint, if we don't have any new fear, uncertainty, or doubt, or any escalation of geopolitical tensions. Without that, we may see some short term gold bulls, but overall start to see a bit of a larger correction taking place in relation to this excessive rally we've seen through the 2024 period, which, when we're zooming out, we have to understand gold has very large corrective waves, right? You can see here after this extended rally, when you started to show signs of exhaustion of failing to break the highs at that time, finally broke that support level that was holding weight for a period of weeks. For the next couple of months, you had thousands of pips of downside and correction. This is what we need to be very careful with as we're looking at the higher time frame positioning here. If gold's not really trading above these prices and breaks this support level over the next couple of months against the macro bullish trend, seeing some corrective phases before we position higher time frame bulls again would not be out of the ordinary at all. It's something we need to prepare for and look out for. And you also have to ask yourself this question from the perspective of an institutional trader or these major banks who've already made huge gains on this rally over the year. And these are at all-time record-breaking high prices in this general area. If you were an institutional buyer and you have already made a large profit on this change from 2023 and 2024, would you want to liquidate some positions from here, or would you want to continue buying from these higher time frame prices when you could easily liquidate some positions, take some profit, and buy at much lower prices because you have the power and market making capability to do so, right? In my opinion, if we're not getting any new catalysts to support more bulls here, we have the higher probability of either consolidating at these highs or seeing these major whales and market makers liquidate positions, profit take on buys, and seeing a correction and then them jumping in from lower demanded buy prices, right? So that's something we need to look out for on gold, and something that's potentially bubbling up in the current economic environment, and when we're looking at intermarket correlations, right? Other than that, in terms of the weekly recap and refresher, nothing too crazy from last week besides the whipsaws from CPI, FOMC having another copy and paste FOMC. The only thing that brought a little bit more volume and volatility was on the Japanese yen, with our prediction coming true of Bank of Japan UAD confirming a slowdown of that unlimited bond buying program, tapering it off, which is a hawkish signal. And I do want to continue some of the dollar bulls this week. I do want to continue some of the Japanese yen bulls. Now, one reminder from a reactive standpoint. If we don't see more Japanese yen bulls in terms of a continuation of sentiment from the Bank of Japan rate decision and dollar starts to pick up more strength, we may see more bulls come in artificially on the yen from a currency intervention. I think it would be a lot more advantageous for market participants to ride the sentiment and words from Bank of Japan UAD and seeing more yen strength naturally as a continuation of the Bank of Japan sentiment. So the Japan government, working in hand with the Bank of Japan, doesn't need to dig into their currency reserves to do another useless stealth intervention. It's time to just us. It's time for us just to see yen picking up some normal strength from here, in my opinion. Now, that was the little recap of last week. Let's check out our fresh scope of events for this coming week, where we have passed a lot of the important data, such as US labor market data, CPI figures, and rate decisions. But let's check out our schedule here, shall we? So I'm just going to be quickly going over some of the main important events that we have this week. Okay. Okay. So June 16th, London session. It's going to be tentative. We have some housing price data from the UK, which is going to give us some more inflation information for the UK in terms of the real estate industry there. Now, the forecast is the same as prior. If these numbers are still higher, showing upside inflation pressures in the real estate market of the United Kingdom, this can still lead to some GBP strength. This can lead to that GJ bounce to retest better sell zones and a GU pullback to retest better sell zones against a stronger dollar as well on the intraday timeframes. I think we may start to see a slowdown amidst the tighter financial conditions and restrictive rates and see some slight declines, which can still keep GBP softer. After that, the next set of important data is at June 17th, 8:30 a.m. Eastern, with your New York Fed manufacturing report. Expected to see a rebound, still in negative integer territory, but cutting the prior number roughly in half, and a potential forecast of -9. If we are seeing that rebound, this can still keep dollar more bullish and potentially extend some of those dollar buys we want to see and that continuation of last week's sentiment. After that, the next set of real important data is on June 18th, Asian session hours for our AUD traders, which I don't primarily look at, but you have your rate decision. They are still expected to keep rates the same, potentially giving some dovish signals in their forward guidance with their actual speech. Then on June 18th, at Asian session close, 5 a.m. Eastern, late London hours, we have some important euro inflation figures. If euro inflation figures are still dropping, adding on to the dovish sentiment and rate cut cycle ECB is starting to enter, this can further support the macro rate differential against the stronger dollar and still continue to extend our euro USD sell side bias. Then we don't really have anything too important until June 18th, North American trading session with your US retail sales and your industrial production monthly data. Expected to see retail sales rebounding slightly and some rebound in industrial production. Both of these would support our bias of extending dollar bulls after some normal intraday liquidity grabs, continuing to go up to the 106.5s and the 107 prices there. Then the next set of important data for the main asset classes that we be looking at is during June 19th London session hours with your UK inflation figures. I'm primarily looking at headline CPI year over year, which is expected to drop to the Bank of England's goal of 2%. If we are dropping to 2%, going to continue to support the potential expectations of near-term Bank of England rate cuts and lead to some GBP weakness, extending GU sells and potentially positioning ourselves for those GJ sells with the yen starting to pick up some more strength as well. After that, if we do see some declines in UK inflation figures on June 19th, this can give us further indication of seeing a slightly more dovish approach with the actual Bank of England rate decision. Now, they're still expected to keep rates steady, still in a restrictive territory stance. What we're going to be focusing more with the Bank of England rate decision is the speech and forward guidance. Are they going to start to be more optimistic with how inflation is looking? Are they going to start to give any clues of signals of when they're going to do their first rate cut or number of rate cuts? And that can further support some GBP bears as well. Then on June 20th, during the North American trading session, we have some initial jobless claims, housing data, and Philly Fed business index data. I'm expecting relatively neutral to on forecast data, just some price whipsaws that day, nothing too major in focus. Then June 20th, Asian session hours. Very important Japan CPI as well as services PMI and manufacturing PMI figure. Now, we want to see Japan inflation accelerating well above 2%. Remember, Japan and the Bank of Japan has had the opposite goals, opposite job of what the Fed, ECB, and of course Bank of England and other major central banks have had. These other central banks have been trying to bring inflation down from high risk levels down to 2% by tightening financial conditions. Bank of Japan's had the opposite problem. They've been dealing with deflation for an extended period of time. They've been trying to continue to stimulate their economy, increase economic activity, and accelerate inflation well above 2% and have it maintained there so that they can finally start giving policy tweaking signals. If Japan's CPI is elevated at forecast here or even higher, and services PMI is also higher, indicating some upside pressure on services inflation and solid business activity there for Japan, this can also support Japanese yen buyers coming in from those lows and continuing the Japanese yen strength from the Bank of Japan sentiment we had last week, which would be perfect to start to position into those GJ cells and other yen pair sells, especially if we notice that buyers are not printing any more highs, starting to see more profit taking from those higher time frame prices and a potential shift in the intraday technical structure. After that, June 21st, London session hours, some UK retail sales. Expecting some pretty mixed data here across the board, can still be relatively softer. Also, during that same London session period, every 30 minutes all the way until 4:30 a.m. Eastern, you have your flash manufacturing, composite, and services PMI. I'm primarily looking at Eurozone overall here in UK. We'll give some more information for that as we get closer to it, as it's towards the end of the week. Last but not least, during the North American trading session, end of the week, June 21st, is your flash S&P global manufacturing, services, and composite PMI. Expected to see some slight declines, but still in relatively optimistic territory, still in expansionary ranges if we're holding well above the 50 grade point. If we're dropping below these forecasts and closer to the 50 point or lower than it, going into contractionary territory, recessionary scare territory, that could potentially lead to a dollar bearish move at the very end of the week, something we need to look out for there. But in terms of the key scope of events through the week, those are the main important pre-planned data events I'm going to be looking out for. And we will be giving some updated analysis ahead of time for that, alongside our daily market update webinars. Okay. So now, in terms of sentiment analysis and some of the intermarket correlation analysis, if dollar is not fading out this upside move, still holding above these rejection points in key level 105, still respecting that intraday bullish market structure formation, give or take some pullbacks for the new weekly lower wick, which we just observed from a technical perspective, but in terms of institutions setting up some better positioning, does look like dollar can still be squeezing to 106.5's minimum and even the 107s, especially if we do have some of that optimistic data into the week as we were discussing through the weekly scope of events. This means I still want to be continuing some Euro USD shorts, GBP USD shorts, UCAD bulls, and potentially starting to see if VIX is picking up some more strength at the support, rate cut bets premiums priced in, more outflow out of your basket of risk currencies and risk assets, more inflow into the dollar, some US 30 bears coming into play, and gold, give or take some heavy liquidity grabs and potential pullbacks in the corrective phase, starting to position some higher time frame bears on gold as well. On Japanese yen, if we're not breaking these last key higher time frame lows, we're not fading out the Bank of Japan move from last week, we are seeing some acceleration in Japan CPI figures and services PMI. We're breaking above this minor bearish structure. I can see yen digging up to these last key price points of interest and still showing some more strength. Obviously, the key events we have through the week is going to be very important. We do have the potential yen can consolidate, but I would love to see market participants riding some of the hawkish clues from UAD from last week and starting to see yen have a correction from these lows and more buy-side orders accumulating here, coming to these price points of interest to the left. So that is what I want to start to play, is some short-term outflow out of your basket of risk currencies and your basket of risk assets, and starting to see some more inflow in the yen, more inflow in the dollar, even starting to see VIX bounce from this support level. Nothing huge, but still respecting that demand zone and support level. Right? Now, in terms of gold here, intraday trade ideas as well as analysis, we understand gold is still in this overall corrective structure, roughly from 2340 highs into the 2300 lows. We can easily still see a bit of a deeper pullback phase if we're breaking back above this gray zone for a short-term bullish squeeze to retest into the a point of structure here in 2360s, 2357s before positioning into better sell side plays, which would not be out of the ordinary at all in my opinion. Otherwise, if we're starting to see this resistance being respected, gold breaking back below the 2320s, then we could still just see this same consolidation, wave formation, very similar to the sequence of events to the left, and at least be retesting into the 2300s before assessing price reactions accordingly, as we still have to be very adaptive to the current market phase we're in. We are not in an impulsive phase of market structure just yet. Those have unfortunately already passed, and we did get to take advantage of them through that China reactive news and NFP day. We are in a phase very similar to what's marked out in the blue box here, a corrective phase where we could still see this bit of an extra squeeze to retest a better sell zone, or just still simply be playing this very annoying wave formation here. Which is something we need to be adaptive to. So those are the main trade ideas I'd be looking at. In terms of a psychology reminder on gold, until we get more fundamental catalysts to lead to an impulsive wave, which could be reactive events of new fear, uncertainty, and doubt for more bulls, or obviously rejecting key supply zones and having optimistic US data and dollar inflows for more bears, my main bias, I would say decrease the quantity of trades you take on gold or cut your risk until we retest into higher time frame positions where you can have a more high probability trade. Just be very selective with your gold trade so far, because it's not hard to see that we're still primarily in this corrective and consolidation phase for the time being right now. Right? GJ, even though GJ had that bearish move and we did snap back below these previous key highs to the left, showing a lot more signs of buyer exhaustion, starting to get some stronger bearish price action, we could easily still retest into these areas and it wouldn't be out of the ordinary at all. Getting roughly a 50% correction of this impulsive leg, retesting into these previous highs before starting to position into better shorts, or needing to break below the 199s to position into better shorts, at least coming down to retest prices into the rough 197.5s and 197s here. So we may still see a short-term bullish squeeze on GJ here, but if we're not breaking above these key prices, I would start to position myself into shorts due to the hawkish clues we received from Bank of Japan UAD, potential of seeing some CPI data accelerating in Japan, bringing some more yen strength, and obviously starting to get some more dovish clues and signals if UK inflation is dropping, and of course with the UK rate decision in the second half of the week. With the UK rate decision the same week as the UK inflation and Japan inflation figures, we do have to be very cautious of aggressive price whipsaws, liquidity sweeps, and heavy indecision moves that could potentially look to shake our bias and create more doubt. But what we're focused on is what key prices are still being respected alongside the fundamentals, bringing together the technicals and the fundamentals to have more information and information advantage to play alongside our higher time frame positioning. So with GJ here, I would see a short-term bullish squeeze, intraday buys and scalp buys if we break back above 199.8 ppl. This would be expected to go back into the 200.5 prices, even 200.8, before positioning into better sell plays at those previous higher time frame highs to the left giving a pretty decent correction of the downside move, but not fully fading it out. Otherwise, if we're breaking below 199.2, breaking below 199, still seeing some more inflows in the dollar, which in terms of intermarket correlations leads to less demand in your basket of risk currencies, and Japanese yen future still showing us some more strength, with the technical break below these prices, I do want to start to position some sells and start to head back down into the lower 197s. Dollar pairs. Now we can start to see stronger bearish structure forming on Euro USD and GBP USD as dollar finally started to get a breakout due to the macro rate differential and rate cut premiums for the Fed being priced in, and Feds themselves still taking a very slow and steady approach. I'm going to be looking for pullbacks to the previous lows, or even more preferably to the key level 1.079 and some of these continuation sell plays. Potential that if we break above current wick rejection prices and candle bodies, you could ride a pullback to retest into better sell zones. But overall, more in a macro and intraday Euro USD bearish bias. On GBP USD, I would love to see if we break above 1.27, short-term pullback to 275 before better sell positioning, or breaking below 1.268 and 266 for continued short sells on GU, playing some of the dollar strength, macro rate differential, GBP bears coming into play with less demand in your basket of risk currencies, stronger bearish structure and bearish price action formation as well, at least going to retest into 263s and 26 key level here. USD CAD. Still a bit messy, but I do want to see if we double bottom into the 3.7 area, hold above 3.74, still seeing some bullish buys on dollar strength, macro rate differential of Bank of Canada doing rate cuts before the Fed, Fed still taking a very slow and steady approach with their rate cuts, still having more demand in your world reserve currency, oil relatively still softer as well, not bringing much more demand into the Canadian dollar, at least wanting to retest into this last point of interest and prices into 1.382. US 30. I do see that if we don't break above 38,700, break below 38,400 with some more inflows in the dollar, rate cut premiums priced in, CPI move being completely faded out, still respecting that liquidity bearish accumulation and liquidity zone to the left, that we could easily retest into this demand zone in previous lows before even thinking about bullish bounces again in the stock market. I see a pullback to 38,700, break below 38,400, at least retesting into 38K flat before assessing price reactions. All right, everybody. So I don't want to be yapping too much. Hopefully that was an educational, informative, and quick webinar covering most topics and angles there. If anybody has any questions, comments, concerns, problems, issues, please let me know in the chat. I'll give you guys a minute or two here. We'll probably be doing our New York sessions from Tuesday to Friday. Monday morning is a 50-50, depending on how volume and volatility is. If we're still consolidating or not seeing much volume and volatility until we see more events unwinding into the second half of the week, then we might not do our Zoom. Tuesday and Fridays guaranteed. I'll be doing an Asian session midweek as well, Asian backtesting and study session. Stay tuned for the London sessions with Muj. And then once I save and upload this, I'll send out the rest of the weekly flow as well. So I'll give you guys a minute in the chat. I don't see any questions or issues so far. So I think that means I did a good job with explaining the weekly recap, scope of events, sentiment review, fundamentals and technicals there, as well as trade ideas. Yeah, okay then. I'm going to save and upload this. I'll see all of you guys later, okay?